It's the Death Show. Sounds creepy. Well, but it isn't. There's lots of stuff you need to know. Ted is here. Let's begin.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Ted, welcome back. This is one of those shows where you get no cue cards.
Perfect.
I've got them all.
I love these shows.
There is no advance prep for you whatsoever. And yes, in fact, we're going to be talking about death, so it's appropriate. I'm wearing black. You're wearing white.
Right.
So
that's kind of counterintuitive.
It is very counterintuitive.
Isn't that what we're telling people?
There we go.
Prepare.
So, well, we are going to talk about preparing. So first question for you: are you immortal?
I tell my children that I'm going to live forever.
There you go. Might not be true.
I'm living through them, obviously. Isn't that why you have children?
Yes, exactly. That's exactly right. So I went on the internet, did some research. Turns out everyone dies so far. Yeah. So according to data I found on the internet, so you know,
100% of people die?
Well, not necessarily, because there's people still alive today.
Right.
109 billion people have lived and died over the last couple 100,000 years. There are 8 billion people alive today, so that's 117 billion humans who have ever lived, which means 7% of them are alive today.
Good to know.
Huh. Now, what does that mean? Nothing. Absolutely nothing.
But you like numbers.
I guess so. So for every person alive today, there are 14 people who are no longer with us.
Good to know.
We'll edit that out. That means nothing. It has nothing to do with the show at all. So
we're standing on the shoulders of giants.
That's it. That's it exactly.
Dead.
Okay, so let's talk about death here, because we get this question all the time,
right?
Probably every week. And that is, well, what happens to my debt when I die? Or what happens to that person I know's debt when I die? You know, I don't want my family to be stuck with it. So I'm going to give you a scenario.
Okay.
And you tell me what the answer is. And this is like a very common scenario. We get this all the time. So we're going to pretend my name is Joe.
Okay, Joe.
Joe.
Is it Joe Detter?
Oh, that could be. My health isn't that great, so I know I'm going to die eventually.
Right. I
have 3 debts. And I want you to tell me what will happen to each of my debts when I die. So the first one is my credit card.
Okay.
What's going to happen to my credit card when I die?
Well, so if there are no co-borrowers, so someone else who has access and use of your card, who's equally responsible for the debt, then the credit card debt becomes a responsibility of your estate. And so I can't tell you what's going to happen with it directly, but I can tell you that your estate has to clear your debts before you start distributing any kind of benefits to your beneficiaries in your will.
Now, my estate has nothing. I have no assets, no nothing.
All right. Well, so then it's it's going to die with you.
It dies with me.
Right.
So that's pretty simple. So if someone phones you up and says, well, you know, I'm worried about my mother's credit card debt, she has nothing.
Right.
Then your answer is
don't agree to be the executor to the estate, because there's some responsibilities and obligations, and unfortunately can't get blood from a stone.
There's nothing there.
Right.
Okay, so the second debt that I have is a car loan. So, which obviously means I own a car, because that's what a car loan is. So what happens if I die with a car loan?
Okay, so again, the first question is anybody else joint on the loan? If they are, they can assume the payments and keep the car, and that's life carries on. In fact, upon death, if there's a joint signature to a debt, they automatically become responsible for 100% of it. Let's assume that there isn't anyone joint on the car loan. Well, they have security, the lender on the car, which means they can come and take the car. They'll sell it. If this is the same Joe that was in our first scenario that has nothing else in their estate, there's nothing else for the car company to get. The debt will just be written off.
It just dies with it. So,
but they're going to take the car first.
Right. And so I understand what you're saying. If, you know, myself, Joe and his spouse were both co-signers on the car loan, then the spouse could just continue making the payments, keep the car. But if Joe's the only name on it, it's like, okay, well, either somebody else is going to have to agree with the car company to pick up the payments, which probably doesn't make sense, because in most cases, car loans are underwater.
Yeah, that's right. I mean, it would be a pretty unique circumstance. Either the car itself was unique and had some sort of sentimental value that a family member wanted to keep, or you're in the interesting situation of the car's actually worth more than the loan, which, as you say,
it's rare. Well, I guess if there's 3 months worth of payments left on the car.
Well, if you've got a 5-year loan and you're more than 3.5 years into it, the car might actually be worth more than the loan.
It's possible. And obviously the last few years have been kind of wacky because used car prices went way up and they're sort of easing back again. So, okay, so I assume your answer is going to be the same with my third debt, which is my mortgage on my house.
Right. So again, if there's a co-borrower or co-owner on the house, then the way the law works in Ontario, at least, is the house now becomes 100% theirs. The only way they're going to be able to keep it is if they continue to maintain the mortgage payments. So the mortgage goes with the house. If they can't make the mortgage payments, then the correct decision is sell it and move on.
Now, with mortgages, as you know, there is a period and then they renew.
Right.
So I sign up, I get a 5-year mortgage. At the end of the 5 years, I renew. Now, so again, let's take, Joe and his spouse are both borrowers on the mortgage.
Right.
Joe dies at year number 2. The spouse keeps making the payments for the final 3 years, but then the mortgage comes up for renewal. Is there a chance that the lender says, well, we're not going to renew it because now there's only one borrower instead of 2? Well,
so the surviving spouse has to qualify for a mortgage. And so, certainly the mortgage company can tell you in advance if that's likely. If you don't miss any payments for the next 3 years, they're going to be more receptive to renewing it for you. But there's a risk. There's a reason there were 2 of you on it in the first place.
Is it common for mortgage lenders to require life insurance on a mortgage?
It is. And it doesn't have to be mortgage insurance, which is a horrible thing to buy. They usually, though, want some sort of life insurance policy assigned to the mortgage so that it'll be paid out when the primary borrower does die.
Okay, and we're going to come back to life insurance because that's an interesting point. So the bottom line, what you're saying is if...
Oh, you know what we didn't talk about? So let's say there is no joint owner on the house. So when someone dies, the executor of their estate is empowered to sell that house. So again, it's probably the most significant asset that somebody has. The executor has the right to sell it, and then obviously the mortgage will be paid off and any writs or assignments on the house will be paid. And then they'll deal with the unsecured debts.
Well, and if there are heirs to the estate, then obviously the house has to be sold or some arrangement has to be made.
That's right.
So that the funds can be distributed. It can't stay in the name of a dead person for the next 100 years. Something,
at least it's not supposed to.
Something has to. Something has to happen.
A couple of movie stories about that.
No doubt. So so the other common question we get is, I've got these debts. I don't want to leave them to my family when I die. And of course, You've just explained that in a lot of cases, you're not leaving them to your family anyways. But the question we get asked all the time is, well, should I file a consumer proposal or a bankruptcy now to clean up my debts so that if I do, pass away, they don't have to worry about it? How do I make that decision about whether I should file or not?
So that decision is as much about your own personal attitude towards this sort of stuff. If the fact that you've got the debts is causing you all sorts of stress and you're literally worried about how this is going to impact your family, it's probably having a negative impact on your health anyway, so it may be moving things along a little quicker than they should be. In that case, it might make sense to file a bankruptcy or a proposal. And each case is pretty unique. We tend to lean towards, do you really need to do it? We've already explained that probably from a financial perspective, when you die, the debts aren't going to survive. They're going to get paid out of your estate, or they're just not going to get paid at all. But lots of people, they can't leave the uncertainty. They want to deal with it.
Now, if I had, let's say, $50,000 worth of credit cards and other kinds of debt, which is pretty typical for the people we deal with.
Yep.
And let's say I've got a life insurance policy, maybe it's through work, that pays out $100,000 to my estate.
Right.
Would that be an example where, okay, I guess if you're, think you're going to die in the next 5 years, then filing the proposal now to reduce that debt maybe makes sense, because otherwise when you die, the $100,000 life insurance proceeds goes into your estate. The estate has to settle your debt first.
So we should be clear about that with everybody. So when you die, the executor, whomever's looking after your estate, does an inventory list. These are my assets. These are my debts. They have to deal with the debts first before any beneficiaries will be entitled to specific gifts. And then there's another tier where it's just general distribution of money. So if there's more debt than there are assets, obviously the first thing that gets lost is that general distribution. And then if you need to go in to sell the specific assets, that's gone too. I mean, it's pretty cut and dry that the creditors are going to get paid first if there's any way for them to get paid.
Right.
Now, for your life insurance question. So the life insurance, unless it's some kind of whole life policy you can borrow against, it really isn't an asset that's realizable while you're still alive.
Right.
That's the whole concept. So if you've got a bunch of debt and you anticipate that you will die sometime in the future, because
that's
unlike
how it
me,
works.
the rest of you will.
That's right. Yes.
it probably does make sense to do a proposal to reduce that debt as much as possible, to allow more benefit to your beneficiaries from the life insurance policy, if that's what you're doing with it.
Yeah, and we've had cases where the person dies, they've still got $10,000 left owing on their proposal payments. The estate is going to get $100,000 from life insurance, which wasn't an asset before they died.
Right.
It only became an asset once they died. In that case, the estate, the beneficiaries might say, hey, yeah, we're willing to pay off the proposal because now that leaves $90,000 for the rest of us.
And the executor has the power to make that decision. Now, if there's no executor, it gets a lot more complicated.
Right. And so we're going to talk about that as well. So bottom line is it really depends on what assets are potentially there.
Right.
And who has signed for the debt. We got to keep driving that point home.
Just because I die, if my wife and I are responsible for a debt, doesn't mean she doesn't have to pay it off. If we're both joint on the debt and one of us dies, the other one's got to pick up the tab.
Yeah, I
think that's her plan.
There you go. No doubt. No doubt. We should have had her on the show. The key point is you are responsible for the debts you signed for.
Correct. Always.
That's we could have just done the show in one sentence there. You are responsible for the debts you signed for.
Right.
So if you and your spouse have co-signed a debt, one person dies, the other person is still 100% responsible for it.
Correct.
It's not a 50-50 thing. You're responsible for the whole thing.
Yep.
But if you are the only person who has signed for that credit card, yours is the only name on it, and you don't have any other assets, when you die, well, the debt dies with you.
Right.
Don't have to worry about it. Okay. But you're right. There is this psychological impact that, I don't want my family being stuck with it.
Right.
Okay. They're not going to be stuck with it. So let's explain that. And I think most people can get over that hurdle. So, okay. Now, next topic. As you know,
pulling out the Bible.
We're pulling out the book here. As you know, back in 2017, I wrote this book, and page number 165, we talked about myth number 18, which was, I am immortal. So you clearly have not understood that this is actually a myth. And so in this chapter, we talk about what we just talked about, that you're not, you're only liable for debts that you've signed for. But then starting on page number 167, I have one of the creepiest section, the creepiest section of the book, which is the death checklist.
Oh, great.
Actually put a death checklist in there. You can all go to your home version.
Do you complete this checklist after you die?
No, this is the key. You have to complete it before you die.
Right.
So I'm going to walk you through a bunch of things. Yeah. And the first three are kind of like the basics. These are no-brainer. Everybody would give the same advice. So, and we've kind of already touched on the first one, which is life insurance. So I believe you made the comment that when I get a mortgage, the bank will say, well, we want life insurance on it.
Right.
So the bank will sell you life insurance.
They will sell you mortgage insurance.
Sorry, mortgage. Well, yeah, life insurance to insure the mortgage when you die.
Right.
So it is life insurance, but yes, it has a very specific purpose. It's to pay off the mortgage. In my experience, and you can agree or disagree with this, banks tend to charge more for life insurance on a mortgage than an equivalent policy if you just went to a life insurance.
They charge more, broker. And over time, you're getting less. So the big issue with the bank's life insurance on the mortgage is, as the mortgage balance declines, the value of the life insurance declines. So the premiums that you would have on a $500,000 life insurance policy probably stay the same if you buy it from an insurance company. Maybe they jump at certain age brackets. But you're going to get $500,000. With the mortgage insurance, if you die on day one, they pay off the mortgage. It's $500,000. You die on 10 years from now, and the mortgage is $125,000. They pay out $125,000, but your premiums were the same. So it just that stuff drives me crazy.
Yeah, and so read the fine print is what we're saying. And again, we want to be very specific on our terms. When we say mortgage insurance, we're not talking about CMHC mortgage insurance that insures the bank.
And we're not talking about payment insurance if you lose your job or if you get sick. We're talking about life insurance specifically designed to pay off the residual balance on the mortgage when you die.
Yeah, which... Okay, we don't object to that. You don't want your spouse, if you die and your income is now no longer part of the family and your spouse, and maybe you've got, dependents, is not going to be able to continue paying the mortgage. It would be great if the mortgage was paid off.
Right.
That would certainly make things better for all concerned. But what you want to do is come up with the least expensive way to do that.
And the one with the greatest benefit.
And the one with the greatest benefit.
Yeah.
So if I can get a $500,000 policy for X, And that way, when I die, well, the mortgage gets paid off and whatever is left over goes into the pot for my family. That's a lot better than paying the same amount for a diminishing value. What is the difference between term and whole life?
Well, so I'm going to deal with whole life first. Effectively, whole life is a form of savings. So the portion of your monthly payment or premium, however you set it up, is accumulating in for lack of a better term, a savings account. And so the policy on your death will pay out a specific amount if there's a term component to it, and then the accumulated value of that whole life component. Whole life insurance isn't that common anymore.
Yeah, it used to be
because it's more expensive.
Right. And so every month I'm paying X number of dollars, and some of it notionally is going towards life insurance, but some of it is going into a pot and is growing in value.
Right. So the opposite, the term insurance is you're buying life insurance that covers a specific period of time, 1 year, 2 year, 5 year, whatever it is. And usually the prices for term insurance change at different age brackets. So I'm turning 62 this year, nothing will happen. Probably when I get to 65, it goes up. At 60, it probably went up.
People don't know how old we are, but that's how old we are. So when I get insurance on my car, that is, it's not life insurance, but it's term insurance.
It is, because it expires. When the period that the insurance coverage is designed to cover expires, then it's done, unless you buy more. And term life insurance is the same way.
Same deal. So again, my advice on this is, well, do some research, do some thinking.
Right.
So how much would whole life cost and what do I actually get?
Yep.
So if I die in 20 years, how much does it pay out? And if versus the term, because with term life insurance, if I'm 80 years old, do I really need life insurance?
Well, and even if the premiums on an 80-year-old would be
pretty high,
excessive.
Right. So the purpose of life insurance is to take care of the people who are left.
That's right.
Well, if by the age of 80, my kids are grown,
yep,
probably my grandkids are grown, my house is paid for, I have money in the bank, do I really need insurance?
Yeah.
Whereas if I'm 40 years old, okay, then I can see how it's
something happens, the family's going to need at least something so that they can transition to their new reality.
Right. It's a much bigger deal. So again, you want to understand the math. In a lot of cases, your employer has some kind of benefit program that may provide an insurance component.
And you've got to treat it like term because basically it's in place as long as you're employed with that employer.
Yeah. Once you leave that employment, then it's gone.
Insurance is gone.
So it may make sense to say, okay, I got $100,000 through my employer. Maybe I want to have $100,000 myself, which I can lock in now so that if I do lose my job, well, there's still coverage. So, okay. So what we're covering is the death checklist and what the basics are. So life insurance, we're not saying you should have it. We're saying you should consider it.
Right.
The next obvious one, and you've already referred to this, is a will.
Yeah. And so a will is basically a legal document that sets out your instructions to your survivors on what they're to do with your estate, your assets, the things that you owned.
And if you don't have a will, then somebody else is going to make that decision.
Right. So if you don't have a will, your estate's going to go into, I believe the term is probate, which means a court's going to basically decide what happens with all this money. It takes a lot longer and it's a lot more expensive.
Yeah. And if what you wanted was, I got 2 kids, I want half to go to one kid, half to go to the other, well, that's why you would have a will then.
Yeah. And a will is not a complicated document. You just got to make sure you keep it up to date. That's all.
Yeah, because as you have kids, or your kids get older or whatever, then it may change. There's a difference between having kids under the age of 18 and over the age of 18 and so on. And in a typical will, it's like, okay, my spouse gets everything. Mm-hmm. And then when my spouse is gone, well, I guess it's their will that's going to decide. But if my spouse predeceases me, then it goes to the kids or whatever.
Right.
You want that all thought out in advance. And I agree with you. It's not like it cost $1 billion to create one.
Yep. I mean, there are lots of online applications that you can use for this, although my advice is it's worth the bucks to talk to a lawyer about it.
Yeah, I agree as well. Think about it and then talk to a lawyer and get it drafted correctly.
Right.
Now, there is a third component, a third legal document called a power of attorney. Mm-hmm. There are 2 of them, at least. Probably more.
Well, they're 2 common ones.
Yeah. A power of attorney for personal care and a power of attorney for property. So what does a power of attorney for personal care mean?
So they're the folks that get to make decisions about your health and medical situation if you are unable to.
Who's pulling the plug?
That's right. That's the short answer.
So And that's kind of important because
So it has to be the child that loves you the most or wants your money the most.
Exactly.
Who will keep me alive the longest?
Difficult decision. But yeah, when I'm incapacitated, somebody has to make a decision.
Right.
And so and again, we're oversimplifying it, but that's what a personal care power of attorney is.
Yep.
And then what is a power of attorney over property mean?
Well, that's the one that's more commonly encountered by people in society. They have the right to basically manage your finances for you, so they can realize on assets. They can actually purchase assets. They can decide which bills are going to get paid, which aren't going to get paid. They're stepping into your shoes financially.
So I become incapacitated.
Mm-hmm.
I'm in the hospital. I'm in a care home, whatever. My property power of attorney could say, okay, well, I'm going to sell your house because you're not going to move back into it. I'm going to put that money into an account where we can then pay your bills. I'm going to make sure your bills get paid, that sort of thing.
Yep.
So someone with some financial acumen would be a good person to select there. Now, again, in all of those cases, both the will and the power of attorney, I quite strongly believe you should talk to a lawyer about that.
Correct.
Because again, you're right. You can get the online forms and fill them in yourself. And maybe that's a good thing to look at so you can at least see the questions you need to ask.
Yeah, you'll know the language that the lawyer's going to use.
But I would still be, if you have any assets at all, then it's probably better to have a lawyer looking at that.
Right.
Okay, now the final piece of advice in the book, Straight Talk on Your Money, still
This
available.
is your death checklist?
Yes. And this is, so everything we just talked about, that's kind of
common sense.
Nobody's going to disagree with any of that.
Right.
The only reason the average person doesn't have a will or a power of attorney is either they didn't think about it or they couldn't afford it. I didn't want to spend the money on a lawyer.
In most cases, they just, I'm going to live forever, so I don't think
I'm
about
immortal, which is exactly a myth. But and the older you get and the more wealth you have, the more important it becomes.
Correct.
I think if you're 20 years old, okay, maybe it's less of a big deal. Now, the other thing, though, that I think is equally important, maybe way more important to think about, is what I call keeping your spouse in the loop.
Right.
Okay? So every family, I'm sure your family is the same, has a division of duties.
Mm-hmm.
So in my family, my wife is a chartered accountant. As you know, she's got a higher IQ than I do by many percentage points. But she's more than happy to have me pay the hydro bill every month.
Right.
She doesn't want to have to deal with it.
But somebody needs to know how to do it if you are incapacitated.
So if the accountant of the family, the bookkeeper of the family, is incapacitated or dead, how does the hydro bill get paid?
Right.
And I mean that literally. How does the hydro bill get paid? Do you get a piece of paper in the mail? You probably don't.
Right. Not anymore.
So in your case, what happens with your hydro bill each month?
Right. Well, so.
Or is it your wife who deals with this?
No, I deal with all that stuff because I'm the accountant.
You are an accountant, yes, okay.
Well, and folks, no matter what people tell you, there will always be one of the two partners in a relationship that looks after the money. That's just the way it works.
Yep.
Even the folks that keep separate finances, the other partner will transfer funds so that all the household bills get paid. It's just the way it works out.
Because otherwise, how would it work?
Well, how would you know? So the hydro bill has to get paid. Am I going to ask you every week, did it get paid? When is it? No, it's right. One person. So anyway, the email comes to me and I pay the bill.
And of course you could set it up as pre-authorized payment. So it comes out, you could pay it yourself, whatever. Now, the funny thing in our family is when we, got everything set up, 25 years ago or whatever, my wife was the one who phoned and set up the cable. And
so you're not on any of the accounts?
Exactly. So they're all
talk to you.
They're all in her name.
Right.
They won't talk to me, but I just pay them. But when I forget to pay them,
they send it to her.
She gets the phone call. What are you? They're cutting our hydro off. What's going on? I'm going, I thought I paid that, but maybe I didn't. So it's probably better to have an actual system,
yes,
as opposed to me waiting for the email to come in or whatever. And I've done lots of videos on this. I mean, I'm a big believer in either set it up with pre-authorized payment or set it up to match your paycheck. So if your hydro bill is $100 a month, you get paid every 2 weeks, automatically send $50. You don't have to worry about it. The point, though, is your spouse or your kid or whoever it is who would be the one taking over should be in the loop and understand how that works.
Well, and you need to take that to the next level, and that might be your next point. Every year on my birthday, I update my password and account checklists so that my wife can find all of the various different places I have money. and get access to it.
I agree. And I was just talking to one of our team members earlier this morning who told me that, because we were talking about this. I said, well, Ted and I are going to record the death podcast. And she said, oh, I'm looking forward to that one. And she told me that.
She didn't think we were going to die on the camera.
No, I don't think so. I don't think so. So she said that her mother has a file folder. Her mother, obviously much older than she is. Mm-hmm. And that's where all the stuff is. Right. So she knows if something happens, where to go and get it. And that's basically what you're describing as well.
Right.
The more advanced way to do that would be to have some online password sharing system. Well, there are many password apps. That's the wrong word for it, but ways to keep your passwords safe.
Yep.
And you can share that with somebody else.
Right.
And you can either set it up so that they have access to it now, or you can set it up that, well, if I haven't logged in for 3 days, they get access, or however it works.
Right.
The advantage of that is as you update your passwords, it's automatically updated.
Yeah. So it's not like me. It only updates it once a year.
Right. So your birthday's in December. We're coming up close. It's like, oh, there's stuff that's 11 months old in there.
That's right.
And there's a lot of stupid websites where you got to re-authenticate and redo this and redo that and two-factor authentication.
Thankfully, they're not using retinal scans yet. That'll really complicate things.
Well, they just keep your eyeball. I think that would be actually pretty simple. So I think the point is, how do the bills arrive? Is it by mail? Is it by email? Right. How do they get paid? Is it automatically by pre-authorized payment? Do I have to go into online banking? And if it is online banking, okay, well, does your spouse or kid or whoever have access to that account?
Right.
Are they able to log in and do things? Do they know how to do that? And even more basic, how do you access the bank account?
Right.
So in my case, my wife and I have a joint bank account. Mm-hmm. So if I'm dead, doesn't matter. She's got access to the account. It's all good. But if you don't, then
what do you do?
What do you do? So, okay. So I think those are some of the key points that we always hit. Is there any final advice you would like to give on death other than try to be immortal and don't die?
Well, the most important aspect of all this is to actually give it some thought. I mean, we're always talking about financial planning, and your death is just another extension of that. At some point, it is going to happen to everybody but me. Mm-hmm. And so you just have to take some basic steps to minimize the impact. Your family's already going to be, distressed because they've lost you. And now if you add to that complications because they don't know how these bills are going to get paid or how they're going to be dealt with, just makes it that much worse.
Yeah, and nobody wants to think about it. I mean, I get that. This is not a happy topic, but you're right. And I kind of like your method. Okay, once a year.
That's a birthday thing.
It's a birthday thing. I think about my impending mortality, and whether it's your birthday or some other day. I mean, do it on Earth Day because that's where you're returning to, I guess, or whatever.
Okay.
But you're right. You got to actually spend a bit of time thinking about it and having a plan,
right?
So that, I was talking to my banker a couple of weeks ago, and he said, "Oh, your TFSA does not have a beneficiary on it." And I'm going, okay, I didn't know that a TFSA.
All right.
He said, I see that your wife is the beneficiary on your RRSP.
Did you ask him why he was looking at your
Why
accounts?
are you looking at all my stuff, dude? That's what bankers do. So I said, okay, put her on as the. Yeah. So it's basic stuff like that.
Right.
That if I'm not here tomorrow, can someone else pick it up? So having a joint account is kind of an obvious one, and I understand there's risks to that because the other person can take the money out of the joint account. But think all those things through so that your family is not disadvantaged at the end.
Exactly.
Excellent. There you go. That is our show on death. We kept it under 30 minutes just to keep it moving on. I think the key point we made in the first half of the show is that you are not responsible for debts you didn't sign for.
Correct.
But obviously debts can impact property. So if you're concerned, get expert advice, talk to a lawyer, or if it's a debt situation, talk to a licensed insolvency trustee. And in a lot of cases, we're going to say you don't need to worry about it.
Right.
But you want to make sure the questions have been asked so you've got expert advice. If you are watching this on YouTube, please like and subscribe. Most of you are listening to the audio version. So again, please subscribe. We're on Apple Podcasts, Spotify, wherever you get your podcasts. So until next week, thanks for listening. I'm Doug Hoyes. That was Debt Free in 30.